Welcome to the deep dive. Today, we're really getting into something fundamental for, well, anyone thinking about their financial future: risk and reward in investing.
That's right.
We all have those goals, don't we? Buying a house, helping family, maybe just retiring comfortably.
Real goals.
Exactly, not just daydreams. And investing is often, the path people take, but it can feel intimidating.
It really can. Lots of jargon, lots of noise.
Yeah, but the basics, the core ideas, are maybe simpler than they seem. So today, we're aiming to cut through that complexity.
Our mission, really, is to give you those key insights so you can feel more confident, more clear about your own decisions.
Make investing less of a black box.
Precisely. It's about making your money work for you, intelligently,
Yeah.
not just throwing it out there in hope.
Like planting a seed, maybe. Needs care, patience.
That's a great analogy. It needs understanding. You need to know the soil, the climate, the risks, and what kind of growth reward you can realistically expect.
Okay, so let's start there. Risk and reward. What are we actually talking about? I sometimes think of those fun fair games.
Go on.
Like the giant teddy bear is the reward, the big win. But there's a real risk you spend your money and, well, walk away with nothing. Or less than you started with.
That's actually a pretty good way to put it. No investment is guaranteed to go up. That uncertainty, that possibility of losing money or not making as much as you hoped,
That's the risk part.
that's the risk. And the potential for your money to grow, maybe significantly, that's the reward side.
But they're linked somehow.
Inextricably linked.
Yeah.
Two sides of the same coin. You really can't have one without the other in investing. It's this fundamental trade-off, meaning if you want the chance for higher returns, you absolutely have to accept higher risk. More volatility, maybe bigger swings up and down.
And the flip side, safer bets.
Safer bets, things designed to protect your initial money, they'll almost always offer lower returns. There's just no magic way to get high returns without taking on significant risk. That's the golden rule, really.
No free lunch, as they say.
Exactly. But the key thing is you get to choose where you sit on that spectrum. What level of risk feels acceptable for the potential reward you're aiming for.
That makes sense. It's about finding your own comfort level. Let's make this real. You mentioned stories earlier like Ben and Chloe.
Right. Classic examples. Both start with the same amount, say, £5,000.
Okay, 5,000 pounds each. What did Ben do?
Ben got caught up in the hype. He heard about this hot new tech company, promised the moon, huge potential returns.
The giant teddy bear.
Pretty much. So he put his entire £5,000 into that one single stock. High risk, aiming for that massive reward.
All eggs in one basket. Risky. And what happened?
Well, the tech didn't take off like expected. The company struggled. The stock price collapsed. Ben lost almost everything.
Ouch. A painful lesson about concentration risk.
A very painful lesson. It shows what happens when you chase those huge returns without managing the potential downside.
Okay, so what about Chloe? Same. 5,000 pounds. Different approach.
Completely different. Chloe wasn't aiming to get rich quick. She wanted steady growth, something she could, sleep well at night with.
Sensible. So what does she do?
She spread her £5,000 out. Diversified. Put it into a mix of well-established companies across different sectors, some tech, sure, but also healthcare, consumer goods, established names.
So not chasing the one big hit, but spreading the risk.
Exactly. And her returns, they weren't spectacular, maybe not the giant teddy bear. Her £5,000 grew to, say, £5,300 over the year.
Modest, but positive. And definitely better than Ben's outcome.
Absolutely. Steady progress. She avoided those huge swings, those sleepless nights. Her approach was about managing risk through diversification and patience.
So it's not just about avoiding risk, but actively managing it, smoothing out the bumps.
Precisely. And most successful long-term investors tend to look more like Chloe than Ben. They focus on finding that balance, steady progress over trying to hit home runs every time.
Which brings us back to the individual, doesn't it? Because Chloe's path might be right for some, but maybe not others. There's no one-size-fits-all.
Absolutely not. It has to be personalized. Your strategy depends entirely on your specific situation.
So what are the key things people need to consider about themselves?
Well, several big ones. First, probably age, or maybe more accurately, your time horizon. How long do you have until you need the money?
Right. Someone in their 20s investing for retirement has decades.
Exactly. They can potentially afford to take on more risk, aiming for higher growth over that long period. They have time to recover from any market downturns.
Whereas someone nearing retirement,
Totally different picture. They need to protect what they've built. Their focus shifts towards lower-risk investments. Capital preservation becomes much more important. Less time to bounce back if things go wrong.
Makes sense. What else? Goals.
Goals are crucial. Are you saving for a house deposit in 3 years? Or your kid's university fund in 15?
Different timelines again.
And different risk capacities. A short-term goal, like that deposit. You probably can't afford much risk. You need that money soon, so you lean towards safer options.
Maybe even cash or something very stable.
Could be. For longer-term goals, though, you have more flexibility to potentially ride out market volatility for better growth potential.
Okay, age, goals. What about just, your current financial situation?
Huge factor. Financial stability. Do you have a safety net? An emergency fund?
You mean cash set aside for unexpected things, like losing your job or a big repair bill?
Exactly. Typically 3 to 6 months worth of essential living expenses sitting in an easy access savings account. This is absolutely critical.
Why critical before investing?
Because if you don't have that buffer and life throws you a curveball, you might be forced to sell your investments at the worst possible time, maybe during a market dip, just to cover costs.
Locking in losses.
Precisely. That emergency fund protects your investments from your short-term life needs. Investing without it is building on shaky foundations.
Got it. Emergency fund first. Then what? Is there a personality element?
Oh, definitely. Risk tolerance. This is more psychological. How do you feel about risk? How would you react if your investments dropped, say, 10% or 20%?
Some people panic, others see it as a buying opportunity.
Right. Think of it like spice tolerance. Are you a chili or a cucumber?
I like that.
Chili means
Comfortable with big swings, the ups and downs. You understand it's part of the deal for potentially higher returns.
and cucumber.
Prefers stability. Gets anxious with volatility. Values peace of mind over chasing the highest possible gains. Neither is right or wrong, but you need to know which you are.
Because your strategy needs to match your personality.
Yes. Your investment plan should let you sleep well at night. If you're constantly worried, checking prices, feeling stressed, your strategy probably involves too much risk for you, even if it looks okay on paper.
So honesty with yourself is key. How do you figure that out? Ask yourself those hard questions. How would I feel? Some people use risk questionnaires. Lots of platforms offer them. They can help quantify it a bit. It's about aligning your investments with your emotional capacity.
Okay, so let's say someone's done that thinking. They've considered their age, goals, stability, and they have a sense of their chili or cucumber level. What are the practical first steps to actually start investing?
Right, moving from theory to action. First, nail that emergency fund. We keep saying it because it's that important. Get that solid foundation in place.
Check. Emergency funds sorted. Then what?
Then start small and make it regular. You don't need a huge lump sum. Investing, say, 50 pounds or 100 pounds a month consistently can be really powerful.
Is that the dollar cost averaging thing?
Exactly. You invest the same amount regularly, maybe monthly. When prices are high, your fixed amount buys fewer shares. When prices are low, it buys more.
So it smooths out the bumps automatically, takes the guesswork out of when to invest.
Pretty much. It removes the emotion of trying to time the market, which is incredibly difficult, even for professionals. It also builds a great saving and investing habit.
Okay, regular investing. What about what to invest in? Back to Chloe's example, diversification.
Yes, diversify. Don't put all your eggs in one basket. Spread your money across different types of investments.
Like different companies?
Yes, but also different asset classes.
Yeah.
So not just stocks, but maybe bonds too. Different regions, UK, US, Europe, Asia. Different industries. The broader the spread, generally, the lower the risk associated with any one part doing badly.
That sounds complicated for a beginner, choosing all those different things.
It can seem daunting. That's why things like multi-asset funds or tracker funds, often ETFs, exchange-traded funds, can be excellent starting points.
How do they help?
Well, a single multi-asset fund might hold hundreds, even thousands, of different stocks and bonds from around the world, all bundled together. So you get instant diversification just by buying that one fund. It does the spreading for you.
That makes it much simpler.
It really does. And finally, probably the hardest part for many people. Keep it simple and think long-term.
Meaning ignore the daily news headlines about the market crashing or soaring.
Mostly, yes. The financial world loves drama, but successful investing is often quite boring. Avoid chasing hot tips. Set up those regular investments. Maybe check in once or twice a year to make sure things are still on track with your goals.
And otherwise leave it alone.
And otherwise, leave it alone to grow over time. Patience is key. Remember that saying, time in the market beats timing the market. Trying to jump in and out is usually a losing game.
That's a really powerful set of steps. Emergency fund, start small and regular, diversify simply, and be patient.
That's the core of a sensible approach for most people starting out.
So wrapping this up, if we circle back to that golden rule, it really is the bedrock, isn't it? Higher potential rewards always mean higher risk. No
No
exceptions.
exceptions. It's the fundamental law of investing gravity.
It's like climbing a ladder, maybe. The higher you climb, the further you can see, the bigger the potential reward. But also, the further you have to fall, the greater the risk.
That's a good way to think about it.
And your job as the investor is to figure out which rung on that ladder feels right for you. Not too low so you get nowhere, but not so high you're terrified of falling. That rule is your compass.
Absolutely. And investing at its heart isn't really about getting rich quick. It's about making smart choices, balancing that risk and reward equation in a way that fits your life, your timeline, your comfort zone,
It's about knowledge, patience.
and maybe a bit of courage to stick to your plan, even when markets get choppy. Ben chased the quick win and lost. Chloe played the long game, managed her risk, and made steady progress. The power really is in your hands to make informed choices.
So here's something to leave you thinking about. What if true financial power isn't just about how much money you end up with, but about the clarity you gain? The peace of mind that comes from understanding why you're making certain choices and knowing you've found your right balance between risk and reward. Maybe your future self is built not just on wealth, but on the wisdom of those choices.